Question 1. Which of the following is the primary factor used by insurance companies to determine an applicant's risk classification for health insurance policies? A. Applicant's age. B. Applicant's family history. C. Applicant's lifestyle and habits. D. Applicant's geographical location. Answer: C. Applicant's lifestyle and habits. Explanation: risk classification is a crucial part of the underwriting process where insurance companies evaluate applicants to assess the likelihood of claims. Health insurance underwriting considers various factors such as the applicant's lifestyle and habits, including smoking, alcohol use, exercise, and eating habits. These behaviors have a significant impact on the risk of health issues, making them central to determining premiums. Other factors, such as age and family history, can also influence underwriting decisions, but lifestyle and habits are directly linked to the applicant's health risk. Question 2, scenario-based. Mr. Thompson, a small business owner, is reviewing his commercial property insurance policy. He has a business interruption rider, but it only covers losses due to fire or flood. After a theft at his business, he seeks to claim compensation for the loss of income during the period the business was closed for recovery. What should Mr. Thompson do to address this issue? A. File a claim for theft under his current policy and request an extension to cover business interruption due to theft. B. File a claim for theft and request compensation under his business interruption rider since it's part of the policy. C. File a claim for theft under his property insurance and purchase additional business interruption coverage for future incidents. D. File a claim for theft under his commercial general liability policy and expect compensation for business interruption. Answer: C. File a claim for theft under his property insurance and purchase additional business interruption coverage for future incidents. Explanation: business interruption coverage typically only applies to losses that are directly caused by insured events such as fire or flood, as outlined in the policy rider. Since theft is not included in Mr. Thompson's current coverage, he will need to file a property insurance claim to address the stolen property. However, his current business interruption rider does not cover loss of income due to theft, so he would need to purchase additional coverage for future interruptions due to theft or other causes not covered by the original rider. It is important for business owners to understand the specific exclusions and limitations of their insurance policies, especially concerning business interruption. Question 3. In Wisconsin, which of the following best describes the primary responsibility of an insurance producer when it comes to handling premiums? A. To retain a portion of the premium as commission and pay the rest to the insurer. B. To collect premiums on behalf of the insurer and forward the full amount to the insurer. C. To negotiate the amount of premium with the client and adjust it according to market conditions. D. To pay the premium out of their own funds if the client defaults on the payment. Answer: B. To collect premiums on behalf of the insurer and forward the full amount to the insurer. Explanation: in Wisconsin, insurance producers are required to act as intermediaries between the insurer and the policyholder. Their responsibility includes collecting premiums from clients and forwarding the full amount to the insurer. Insurance producers must comply with fiduciary duties and cannot misappropriate the funds, meaning they cannot retain premiums beyond the agreed upon commission. Proper handling of premiums is critical for regulatory compliance, and any failure to follow this process can result in penalties, including license suspension or revocation. The producer is not responsible for adjusting premiums or paying premiums out of pocket if the client defaults. Question 4. Which of the following is an example of a named peril policy in property insurance? A. A policy that covers all risks except those specifically excluded. B. A policy that only covers damages from fire, theft, and vandalism. C. A policy that covers only the perils listed in the policy, such as fire and lightning. D. A policy that includes coverage for property damage and bodily injury from any accidental event. Answer: C. A policy that covers only the perils listed in the policy, such as fire and lightning. Explanation: a named peril policy specifically lists the types of perils that are covered under the policy. If the peril is not listed, it is not covered. For example, a policy that covers fire, lightning, and theft is considered a named peril policy. On the other hand, more risk or open peril policy covers all risks except those explicitly excluded in the contract. Understanding the difference between these two types of policies is essential for correctly identifying coverage under a property insurance policy. Question 5. Which of the following is a characteristic of universal life insurance that distinguishes it from whole life insurance? A. The death benefit and premiums are fixed for the life of the policyholder. B. It offers flexibility in premium payments and death benefit amounts. C. It does not provide any cash value accumulation. D. The policyholder cannot make any changes to the coverage after issuance. Answer: B. It offers flexibility in premium payments and death benefit amounts. Explanation: Universal life insurance is known for its flexibility, allowing the policyholder to adjust both the premium payments and the death benefit amounts. This type of insurance provides a cash value component that grows over time, but the policyholder has the option to increase or decrease premiums and alter the death benefit based on changing needs or circumstances. In contrast, whole life insurance typically features fixed premiums and death benefits, offering less flexibility. This flexibility makes universal life insurance more adaptable for policyholders who want more control over their coverage. Question 6. Scenario-based. MS. Ramirez, a health insurance policyholder, has a $500 deductible for her major medical insurance plan. She visits the doctor for a medical procedure that costs $2,000, and the insurance company pays 80% of the bill after the deductible is applied. What amount will MS Ramirez have to pay out of pocket for the procedure? A. $400, B. $500, C. $600, D. $1,000. Answer: C. $600. Explanation: To calculate what MS Ramirez will pay out of pocket first, the deductible must be subtracted from the total cost of the procedure. Total bill $2,000, deductible $500, amount remaining after deductible $2,000. 500 equals $1,500. Next, the insurance company covers 80% of the remaining $1,500. 80% of $1,500 equals $1,200 paid by the insurer. The remaining 20% of $1,500 equals $300 paid by MS Ramirez. Now add the deductible to the 20% that MS Ramirez has to pay. $500 deductible plus $300, 20% of $1,500 equals $600. Therefore, MS Ramirez will pay $600 out of pocket. Question 7. Which of the following is a violation of the twisting rule in insurance practices? A. A producer advises a client to replace their old policy with a new one that offers better coverage. B. A producer encourages a client to purchase a policy that suits their current needs without providing alternative options. C. A producer convinces a client to replace an existing insurance policy with a new policy for the purpose of earning a commission even though the new policy does not offer any better benefits. D. A producer discloses all commissions earned to the client at the time of the sale. Answer: C. A producer convinces a client to replace an existing insurance policy with a new policy for the purpose of earning a commission even though the new policy does not offer any better benefits. Explanation: Twisting is an unethical practice where an insurance producer convinces a policyholder to replace an existing policy with a new one that may not offer better benefits solely for the purpose of earning a commission. This practice is prohibited because it can result in unnecessary financial burden for the client, who may not benefit from the change. The producer's duty is to act in the best interest of the client, ensuring that any recommended changes genuinely improve the client's coverage or terms. Question 8. In Wisconsin, where must an insurance producer inform a client of their fiduciary duty to disclose all commissions earned during the sale of an insurance policy? A. At the time of the sale or before the policy is issued. B. At the time the policy is purchased and annually thereafter. C. Only when the client specifically requests the information. D. At the time of the sale and at every policy renewal. Answer: A. At the time of the sale or before the policy is issued. Explanation: In Wisconsin, insurance producers are required to disclose any commissions or compensation they will receive in connection with the sale of an insurance policy. This disclosure must occur at the time of the sale or before the policy is issued, ensuring transparency. Producers must provide clients with full information about their financial interests in the sale to avoid conflicts of interest. This disclosure is part of the producer's fiduciary duty to act in the best interests of the client and to ensure ethical conduct. Question 9. Which of the following is an example of a comparative negligence defense in liability claims? A. A plaintiff is found to be completely at fault for an accident resulting in a dismissal of the case. B. A plaintiff's own negligence contributed to the accident, but they are still entitled to full damages. C. Both the defendant and the plaintiff share responsibility for the accident, and damages are allocated based on their respective degrees of fault. D. A defendant is found to be strictly liable for damages regardless of their actions. Answer: C. Both the defendant and the plaintiff share responsibility for the accident and damages are allocated based on their respective degrees of fault. Explanation: comparative negligence is a legal doctrine that allows damages in a liability claim to be divided based on the degree of fault of each party involved. Under this rule, if both the defendant and the plaintiff are found to be at fault for the accident, the damages will be allocated according to the percentage of fault each party bears. For example, if the defendant is found 70% responsible and the plaintiff 30% responsible, the plaintiff would recover 70% of the total damages while the defendant would recover 30%. This is distinct from contributory negligence, where any degree of fault by the plaintiff may bar recovery entirely. Question 10. Which of the following is not a primary responsibility of an insurance producer when dealing with clients? A. Ensuring that the client fully understands the terms and coverage of their insurance policy. B. Guaranteeing that the client will never experience a loss while covered under the policy. C. Disclosing any conflicts of interest related to the sale of insurance policies. D. Acting as a fiduciary, ensuring the client's best interests are prioritized in all transactions. Answer: B. Guaranteeing that the client will never experience a loss while covered under the policy. Explanation: an insurance producer's primary responsibilities include ensuring clients understand their policies, disclosing any conflicts of interest, and acting in the client's best interests. As a fiduciary, however, it is not the producer's responsibility to guarantee that client will never experience loss while covered under the policy. Insurance policies are designed to provide financial protection in the event of certain risks, but they do not guarantee the absence of loss. The producer's role is to provide proper advice and offer the appropriate coverage based on the client's needs and circumstances. Question 11. Which of the following is a key feature of a basic form property insurance policy? A. It provides coverage for all perils unless specifically excluded. B. It provides coverage only for the most common risks, such as fire, lightning, and vandalism. C. It includes coverage for both physical damage and liability risks. D. It offers extensive coverage, including water and earthquake damage. Answer: B. It provides coverage only for the most common risks, such as fire, lightning, and vandalism. Explanation: a basic form policy is a type of property insurance that provides coverage for a limited set of risks, such as fire, lightning, wind, and vandalism. It is considered more limited than the broad form or special form policies, which offer a wider range of coverage. Understanding the differences between the various types of insurance forms helps policyholders choose the most appropriate level of protection for their needs. Question 12. Which of the following is a typical exclusion in a standard homeowner's insurance policy? A. Damage caused by a covered peril such as fire. B. Damage from an earthquake. C. Theft of personal property. D. Damage caused by vandalism. Answer: B. Damage from an earthquake. Explanation: standard homeowners insurance policies typically exclude damage caused by certain natural disasters such as earthquakes and floods. Policyholders who wish to be covered for these risks must purchase additional coverage, such as an earthquake rider or a separate flood policy. It is important for homeowners to understand their policy's exclusions and make appropriate adjustments to ensure full coverage. Question 13. Scenario-based. Mr. Lee's car insurance policy includes $50,000 in bodily injury liability per person and $100,000 per accident. If Mr. Lee is involved in an accident where one person suffers $30,000 in injuries and another suffers $80,000 in injuries, how much will his insurance policy cover? A. $50,000. B. $80,000. C. $100,000. D. $130,000. Answer: C. $100,000. Explanation: in this scenario, Mr. Lee's insurance policy will cover up to $50,000 per person for bodily injury. The first person's injuries of $30,000 are covered, and the second person's injuries of $80,000 exceed the $50,000 limit per person. However, the overall accident limit is $100,000. The policy will cover $50,000 for each injured party, totaling $100,000, which is the maximum per accident. Question 14. Which of the following is an example of a hazard in insurance terms? A. A wildfire that causes extensive damage. B. A slippery sidewalk that increases the risk of injury. C. A car accident that leads to a personal injury claim. D. A flood that damages property. Answer: B. A slippery sidewalk that increases the risk of injury. Explanation: in insurance terms, a hazard is a condition or situation that increases the likelihood or severity of a loss. A slippery sidewalk is a hazard because it increases the risk of a slip and fall accident. Hazards do not necessarily cause a loss directly, but they contribute to the likelihood that a loss will occur. For example, a wildfire or flood would be considered a peril, while the hazardous condition, like a slippery sidewalk, increases the chance of such an event leading to injury or damage. Question 15. Which of the following best describes a waiver of premium rider in a life insurance policy? A. It waives the premiums for a period after the policyholder's death. B. It allows the policyholder to cancel the policy without penalty. C. It ensures that premiums will be waived if the policyholder becomes disabled. D. It reduces the amount of coverage if the policyholder fails to pay premiums. Answer: C. It ensures that premiums will be waived if the policyholder becomes disabled. Explanation: a waiver of premium rider is an optional addition to a life insurance policy that ensures premiums will be waived if the policyholder becomes disabled and is unable to work. This rider protects the policyholder from losing their coverage due to an inability to pay premiums during a period of disability. It does not apply after the policyholder's death or in the case of non-payment due to financial issues. Question 16. Which of the following types of health insurance policies provides coverage for injuries or illnesses resulting from an accident? A. Major medical insurance. B. Accident-only insurance. C. Disability income insurance. D. Critical illness insurance. Answer: B. Accident-only insurance. Explanation: accident-only insurance is a type of health insurance policy that covers only accidents and injuries resulting from those accidents. It does not provide coverage for illnesses or other medical conditions. This type of policy is typically less expensive than comprehensive health insurance plans, but is more limited in scope, focusing solely on injuries resulting from accidents. Question 17. Scenario-based. Mrs. Stevens owns a business and has a commercial property insurance policy. A fire causes significant damage to her business property, but the policy's deductible is $5,000. The total loss amounts to $25,000. How much will the insurance company pay to cover the loss? A. $5,000. B. $10,000. C. $20,000. D. $25,000. Answer: C. $20,000. Explanation: when a deductible is applied to a policy, the policyholder must pay that amount out of pocket before the insurance company will cover the remaining loss. In this case, Mrs. Stevens' deductible is $5,000. The total loss is $25,000, so after subtracting the deductible, the insurance company will pay $20,000, $25,000, $5,000. Question 18. Which of the following types of insurance provides coverage for medical expenses related to a work-related injury? A. Workers' compensation insurance. B. Health insurance. C. Auto insurance. D. Life insurance. Answer: A. Workers' compensation insurance. Explanation: workers' compensation insurance provides coverage for employees who are injured or become ill as a result of their job. It covers medical expenses, lost wages, and other costs related to work-related injuries. This type of insurance is mandatory for many employers in most states and is designed to ensure that employees receive compensation if they are hurt on the job. Question 19. Which of the following describes the principle of indemnity in insurance? A. The policyholder is compensated for the full value of a loss, regardless of the actual lost amount. B. The insurer pays only for the amount of the loss that exceeds the policyholder's deductible. C. The policyholder should not profit from an insurance claim but be restored to the same financial position they were in before the loss. D. The insurer guarantees payment for a loss regardless of the policyholder's actions. Answer: C. The policyholder should not profit from an insurance claim but be restored to the same financial position they were in before the loss. Explanation: the principle of indemnity ensures that an insurance policy will return the policyholder to the same financial position they were in before the loss, but not allow them to profit from the loss. This principle prevents overinsurance and ensures fairness in claims, helping to avoid situations where policyholders might receive more than the value of the loss. Question 20. What is the purpose of a coinsurance clause in a property insurance policy? A. To limit the insurer's liability in cases of partial damage. B. To reduce the deductible amount the policyholder must pay in case of a loss. C. To ensure the policyholder maintains a certain level of insurance coverage relative to the value of the property. D. To require the policyholder to purchase additional coverage for natural disasters. Answer: C. To ensure the policyholder maintains a certain level of insurance coverage relative to the value of the property. Explanation: a coinsurance clause in property insurance requires the policyholder to insure their property for a specified percentage of its value, often 80%, 90%, or 100%. If the policyholder does not maintain the required level of coverage, they may be penalized in the event of a claim receiving less compensation than they would have otherwise. The clause is designed to encourage policyholders to insure their property adequately to avoid underinsurance. Question 21. Which of the following best describes the adverse selection problem in insurance? A. When insurers offer excessive coverage options to consumers. B. When policyholders with high risk are more likely to purchase insurance. C. When insurers deny coverage based on the insured's claims history. D. When insurers provide discounts to attract low-risk policyholders. Answer: B. When policyholders with high risk are more likely to purchase insurance. Explanation: adverse selection occurs when individuals who are more likely to experience a loss are more likely to buy insurance. This creates an imbalance, as the insurer may end up insuring higher-risk individuals, potentially leading to higher claims and increased costs for the insurance company. Insurers try to mitigate adverse selection by using underwriting practices and other risk management techniques. Question 22. What is the primary purpose of liability insurance? A. To cover the costs of repairing damaged property. B. To provide compensation for lost income due to disability. C. To protect the insured against claims for bodily injury or property damage to others. D. To cover the medical expenses of the insured. Answer: C. To protect the insured against claims for bodily injury or property damage to others. Explanation: liability insurance is designed to protect individuals and businesses from the financial impact of claims made by third parties for injuries or property damage caused by the insured's actions or negligence. It does not cover the insured's own medical expenses or property damage, but rather the costs associated with legal defense and damages to others. Question 23. Which of the following is an example of a peril in insurance? A. An icy sidewalk that increases the risk of slipping. B. A broken pipe that causes water damage to the home. C. A house located in a flood-prone area. D. The homeowner's failure to maintain the property. Answer: B. A broken pipe that causes water damage to the home. Explanation: a peril is a specific cause of loss or damage covered by an insurance policy. In this case, a broken pipe is a peril that can lead to water damage. Other options describe conditions or factors that may increase the likelihood of a loss but do not themselves constitute a peril. Question 24, scenario-based. Samantha has a homeowner's insurance policy that covers fire damage, but it has a $1,000 deductible. A fire causes $5,000 in damage to her home. How much will Samantha receive from her insurance company? A. $4,000. B. $5,000. C. $6,000. D. $1,000. Answer: A. $4,000. Explanation: after applying the deductible of $1,000, Samantha will receive $4,000 from her insurance company to cover the $5,000 in fire damage. The deductible is subtracted from the total claim amount and the insurance company pays the remaining balance. Question 25. Which of the following describes underwriting in the insurance industry? A. The process of investigating and settling claims. B. The process of deciding how much coverage to offer and at what price. C. The process of advertising and marketing insurance products. D. The process of paying out claims to policyholders. Answer: B. The process of deciding how much coverage to offer and at what price. Explanation: underwriting is the process through which an insurer evaluates the risk of insuring a person or entity and determines the terms of the policy, including the premium amount and coverage limits. The goal of underwriting is to ensure that the insurer is accepting risks that align with their risk management strategy while charging appropriate premiums for those risks. Question 26. What type of insurance covers the costs associated with the replacement of lost or stolen personal property? A. Renter's insurance. B. Workers' compensation insurance. C. Life insurance. D. Liability insurance. Answer: A. Renter's insurance. Explanation: renter's insurance typically covers personal property losses due to theft, fire, vandalism, or certain other perils. This type of insurance is designed for individuals who rent or lease their homes and need protection for their belongings, but it does not cover the building structure itself, which is typically covered by the landlord's insurance. Question 27, scenario-based. If an individual fails to disclose a pre-existing health condition when applying for health insurance and the insurer later finds out what could happen, A, the insurance policy could be automatically cancelled. B, the individual will be required to pay additional premiums. C, the insurer may refuse to cover treatments related to the condition. D, the individual will be refunded for the premium paid. Answer: C, the insurer may refuse to cover treatments related to the condition. Explanation: failure to disclose a pre-existing condition when applying for health insurance could lead to the insurer refusing to cover any treatments related to that condition. This is considered a violation of the duty of full disclosure, and the insurer may deny claims associated with the undisclosed condition, or in some cases cancel the policy altogether. Question 20. Which of the following is an example of actual cash value in property insurance? A, replacing a damaged item with a brand new one of the same value. B, paying for the cost to repair or replace the damaged property minus depreciation. C, providing a lump sum payment to the policyholder for their losses. D, paying a set amount for specific types of damages regardless of the actual loss. Answer: B, paying for the cost to repair or replace the damaged property minus depreciation. Explanation: actual cash value, ACV, is a method of selling insurance claims in which the insurer pays for the replacement or repair of damaged property but subtracts depreciation based on the item's age and condition. This is in contrast to replacement cost coverage, which pays for the full cost of replacing the property with a new one. Question 29. Which of the following types of insurance would be most appropriate for a small business owner to protect their business assets and liabilities? A, health insurance. B, business owner's policy BOP. C, homeowner's insurance. D, travel insurance. Answer: B, business owner's policy BOP. Explanation: a business owner's policy BOP is a type of insurance designed for small businesses. It typically combines several types of coverage, such as property insurance, liability insurance, and business interruption insurance, into one package. This allows business owners to protect their assets, operations, and employees under a single policy. Question 30. Which of the following best describes collision coverage in auto insurance? A, coverage for injuries to the driver and passengers of your own car. B, coverage for damage to your vehicle caused by an accident with another vehicle or object. C, coverage for theft or vandalism of the vehicle. D, coverage for medical expenses related to an accident. Answer: B, coverage for damage to your vehicle caused by an accident with another vehicle or object. Explanation: collision coverage in auto insurance pays for damage to your vehicle resulting from a collision with another vehicle or an object, such as a tree or a fence. This coverage applies regardless of who is at fault in the accident. It is different from comprehensive coverage, which covers other types of damage, such as theft or vandalism.